This is you ending fire, then we shall all burn together. Watch the flames climb high into the night, calling out Father, oh, stand by and we will watch the flames burn over and on the mountainside. And if we should die tonight, we should all die together. Raise a glass of wine for the last time, calling out Father, oh, prepare as we will watch the flames burn over and on the mountainside. Desolation comes upon the sky. Now I see fire inside the mountain. I see fire burning the trees, and I see fire hollow and soul. I see fire blood in the breeze, and I hope that you remember me. Surely I'll do the same. Confined in mountain holes, we got too close to the flame. Calling out Father, oh, hold fast and we will watch the flames burn over and on the mountainside. Desolation comes upon the sky. Now I see fire inside the mountain. I see fire burning the trees. I see fire hollow and soul. I see fire blood in the breeze, and I hope that you remember me.
Hey everyone, thanks for joining. So I had a bit of an issue trying to stop the sharing of the screen there. So you probably saw my Ed Sheeran on YouTube playing. Anyone has any better advice on what songs to use? We've been using that one for a while. Feel free to let me know. Hopefully you guys can all hear me. We've got Josh from Xact Accounting and Keenan from Hazard Co on there as well. If you guys want to pop your cameras on, if you can hear me okay. Yeah, brilliant. Awesome. So thanks everyone for joining. So as the webinar title, and you've probably seen, it's tax tips. We ran this one last year around this sort of time. Maybe it was just the first week of June, I think, Josh, but heaps of questions. Just everyone's in the chat asking, so make sure you do that, guys, because there's obviously a lot of tax questions that people have around this time of year, and asking those to someone that actually knows what they're talking about. Don't ask Keenan or myself, because we will not be giving you any tax advice. But yeah, get your questions in. So what we normally try and do is just sort of go through as much of the presentation as we can. There'll be a little break with Josh and stuff in there for questions, but we'll try and leave most of them to the very end. But like I said, get them in and whatnot. Just some housekeeping before we kind of go any further on this. You can ask questions in the Q&A section. Personally, I tend to find the chat is the best option, and just make sure you send it to all all attendees on the webinar. It just encourages people to chat, and you guys can see each other popping those in. So definitely do that. Before I throw to Keenan, just to kind of introduce himself and what Hazaco do, I'll just want to quickly give you guys a bit of a heads up, because a lot of people on this call will be either Build Xact users or Hazaco users, or from Xact Accounting as well. So I just want to just make you guys aware that if you don't already know, and hopefully this share screen works again, Build Xact have a Facebook group now, and it's really useful. So it's called the Build Xact Building Block, and it's really useful for just hopping in and asking questions to other Build Xact users, asking questions to the Build Xact team. It's a really good sort of source of information. You can communicate with the Build Xact team on there as well. So we'll talk about feature suggestions. We might open things like little beta programs on feature testing, all that kind of stuff. So if you are interested, the Build Xact building block, it's really good. Even for me, I've learned stuff from just going in there and reading the comments and how people do things. Like we'll build a feature and we don't intend it to be used a certain way, and people use it in a certain way. So it's a really good source of information. So definitely hop on and join that if you haven't done so already. So I'll just quickly stop sharing. And obviously, for those of you guys who don't know, Build Xact, we're online estimating and job management software for builders. So an end-to-end system really for estimating in your project management side. And then Hazaco, Keen will obviously talk about what they do and really sort of getting you up and running on that safety side. But I'll throw to you, Keenan, now, if that's all right, mate.
Hey, Julian?
Yeah, I can hear you.
Awesome. So Hazaco is a health and safety solution. If you didn't hear about us yet, what we try to do is helping thousands of builders here in Australia and trades on managing their health and safety, keeping on top of everything health and safety. If you would like to know more information about us, please feel free to call me, contact me, even through Julian and Build Xact. We have a great and amazing partnership with them. If you would like to go as well to our website, there's a lot of nice videos and introduction about the solution. And you can sign up for a free 1-week trial. Give it a crack. And if you need any help, we're here to help you and hopefully show you the solution. Cheers, man. I will jump and pass the mic to my good friend Josh, and he will lead that.
Yeah, I think this is the part, Josh, now where Keenan and I shut up and
I'll leave you to say thanks.
I thought you guys would just do all the tax questions and I'll just blast through the content. Yeah.
We're just like, yeah, the government will be, the ATL will be fine with it. Just
they're fine with it. Yeah, absolutely.
Awesome.
Awesome.
Right, we'll turn our screen off, mate. We'll give you the floor.
Yeah, I'll
Cheers, mate.
share screen. Give me a thumbs up.
It's loading. Yeah, all good.
Beautiful. Well, thanks, Julian. Thanks, Keenan. It's great to have you on this year, Keenan, with the Hazard Co. And so, as Julian mentioned, last year we had a heap of interest in the webinar. Last year, the content was well received. We got a heap of questions on the webinar, and we are 12 months down the track, and here we are again. It's that critical time of year where you need to be thinking about end of financial year, need to be thinking about what tax maneuvers you need to be doing ahead of 30 June. And the key thing is having the right conversations with your accountant around this time of year. So, we're Xact Accounting and we're specialist building construction accountants. So we really have a deep knowledge of your industry. With the content today, I've broken it up into a few different sort of areas. So the first bit we want to sort of cover off on is some tax foundational or essentials pieces to running a business that you really need to be thinking of sort of at all phases, but also when you're starting a business. And it's important to get your head around these fundamentals and not just the tax, what you can claim every year. We'll also have a little bit of a look at the ATO's current hit list, what's on their radar. And the key thing that these things are on the radar is because they've got good data matching these days. So let's talk about how they're using that and what you need to be aware of. We'll then take a quick break from there just to see if there's any questions, but then we'll sort of get into that real practical piece, which is the main questions that come up through this webinar is around, well, what can we claim? Assets, expenses, and it's that sort of question around, well, is it business or is it personal or is it a bit of a both? And then we'll sort of do a bit of a wrap around, well, what came out of that budget that just got released a few weeks ago? Is there anything in there for you? What's changing? Things that you need to be aware of. sure that flips. Okay, so before I dive into the foundations, one thing I want to highlight, and it's really important, is this distinction between tax accounting and commercial accounting. And so we're sort of industry insiders in this, and we specialize in the building construction, and we have both skill sets on both the tax accounting and commercial accounting aspects of running a building company. So the key to this is that tax is tax and accounting is accounting, and they don't talk the same language, and neither should they. And so I'll give you an example of why this is important. And the key one we see is the immediate asset write-off is the main example we get around this. And so, as we know, the last few years, buying assets, you can immediately claim the tax deduction for most of them because there's been an unlimited threshold for buying assets. And so what we've commonly seen is assets, because you can claim this deduction, they're just being written off through expenses and washed through the profit and loss. But the problem is, if you're looking at your financials on a tax basis, it's really going to understate your profit, and all of a sudden your asset doesn't exist. And it's sort of more of a hygiene thing here from that sort of how you're looking at your financials. If you're writing assets off, and a lot of these assets, cars, etc., you might have loans on them or leases on them. And so what you end up doing is you're understating the value of your business and also your profit. And so you really don't want to be doing that, particularly when you're using those financials for making decisions as a business owner on, how's the business performing. But the real key thing is third parties like banks, etc., also use these financials when you're going to get funding. And so you have to have this distinction between tax and accounting. And a specialist like us, we know that those two concepts are different. And really, key thing is taxman wants the tax numbers, but the owner and other third parties really need the accounting numbers. So you really need to be making sure that you've got both the commercial hat and tax hat on when you're running a business. Now let's jump into the tax foundationals part of the webinar. So the starting point for any business, that decision around, well, what structure am I going to use? Am I going to be a sole trader? Am I a company, trust? What am I going to use? And this decision is very, very important at the beginning. And the short answer to this is it has to be fit for purpose. You have to think about what stage in your sort of cycle of growth you are, goals, complexity in your world. So one key sort of starting point, look at if you're a small operator and you don't have any dependents, you haven't really accumulated any major assets, you don't yet own a house, it's probably okay that a sole trader structure is a good starting point for you. But that usually sort of runs its course, particularly if you want to grow your building construction business. So when more complexity comes into your life, and you've got dependents, you've got families, you've now got family homes, and you've got assets, you really, really need to be thinking about structures to safeguard. So, and it comes off the back of this industry, as we can see, has the highest number of insolvencies, and for obvious reasons, it's a very complex industry. Building construction businesses are very complex to run, and so you need to be thinking about, well, how can I safeguard my personal life from the business life, knowing that there's some risk there. And you need to be thinking about the tax implications as well as that commercial side of things around how do you keep your personal assets safe. You also need to be acutely aware of the structure you're using and how that might flow into your licensing requirements in your relevant state. So an example here in Queensland, you have to be very careful of the sort of structure you use just because of how regulated building construction is here in Queensland, but it's not so dissimilar to other states as well in terms of structures that may or may not be most effective from that commercial side in your licensing. Now, trusts are a really big topic, and it comes up a lot, and it's actually a very commonly used structure. A trust, or you may have heard the phrase family trust, discretionary trust, it all means the same thing. They're commonly used by accountants, set up to run businesses out of, and there's two key reasons why they're really excellent vehicles to use. And the first one is, and it's off the back of what I was just saying, is they're really good for asset protection. The key reason why they're good for asset protection is because a trust doesn't have a particular person that owns the assets. So by its nature, a trustee is there to hold assets on behalf of beneficiaries of a trust. Now, most family trusts or discretionary trusts have a very broad range of beneficiaries, very, very wide range of beneficiaries, including yourselves as the business owners. And because that broad range of beneficiaries exists, if someone was to attack the trust, they can't really point to anyone in particular to actually attack. So it's really difficult to attack trust assets. And so that's one of the key ones. The second one is really that flexibility around what you can do with the income with the trust. And so they, particularly when you've got a family, sort of broad range of family members and particularly adult children, that you can use trust to sort of spread the income across sort of lower tax bracket individuals. And it's really good from that sort of flexibility because the trustee, which is you guys running your businesses, get to make that choice every year on who's going to pay the tax. But you do need to be careful. So last year, when we spoke about trusts and distributing to adult children, the ATO had just released some new guidance around, focusing on this area and particularly those who were distributing to adult children, but there was no real benefit flowing to the adult child. And so we're 12 months on now, and the ATO still have trusts under the microscope, and particularly distributions to adult children. And the key thing is you just need to have a really good understanding of this and a plan around, or a good reason why you're distributing to the adult child. And at a really simple level, what the ATO are expecting is if you're going to access lower tax rates of an adult child, so there might be someone who's in uni but not generating any other income over 18, if you're going to distribute to them and access their lower tax rate, you really do need to make sure the benefit of that distribution actually flows to that beneficiary or that child. And so the simplest form is obviously you pay the cash to them. That's a really simple way. But there's also a few other ways that you can actually do this. You just need to have a really well-documented sort of plan around it. And it's very obvious that the actual benefit of the trust that you're providing to the adult child is actually flowing to them. So you absolutely still can use adult children in the trust, but you just have to make sure you're very careful and you have a good understanding and reason why you're doing that. Now, a bit more on trusts. Now, they're excellent vehicles to use trusts from that sort of tax and asset protection, but there are also some commercial aspects to trusts that do cause some issues. And I'll give you a bit of an example from up here in Queensland, just because this is the highest regulated state, so I'll give you this quick example. So because of that nature, that no one particularly owns the assets in a trust, up here in Queensland, you need to have net tangible asset requirements to hold your license. If you're in a trust, QCC does not recognise the assets of a trust to meet your financial requirements. And so that's a really big sort of commercial downfall of a trust in Queensland. And you basically need alternative approaches to meet the financial requirements in the state, which then typically means the asset protection you put in place with the trust basically gets, limited because you've ended up having to stitch other assets in. So we typically avoid using trusts as a trading entity, but trusts do still have a very important role in your structure. You just have to use them in a different way, but you can still access the benefits of the trust. You just need to know what you're doing, need to be using specialists to actually navigate those elements to trust. So you're probably sitting here thinking, oh, okay, if they're great for tax, but for a bunch of reasons, they might be really quite painful to use, and should we just be changing structure because they can be commercially difficult to use at times? And I want to really highlight this, that you need to be thinking about this with a lot of caution. So you might be having a discussion with your accountant and go, okay, we want to change out of a trust and go to a company because they're easier to use. Don't just do that off the back of not really understanding the complications around it. So, accountants are really quick to jump on restructuring a group, but there's a lot of complexity to it. And a lot of the complexity actually falls with you guys as the business owners on what actually goes into changing structures. So you can see there's a few sort of, obvious ones that, you'll be getting a new ABN and it'll be a new structure altogether. So you'll be having to change bank accounts, branding's probably going to change. You'll need a new accounting file set up. You may even have some contracts that are already on foot. You need to make sure that you don't just change structure and start invoicing out of another company, because there's some very important legal aspects to that as well. And you need to be thinking about, you've got employees, you're going to have to change their contracts over, etc. as well. And of course, there's accountants and lawyers' fees to actually be able to change structures. So trusts are really good to use. They're good benefits. Don't run out and pull the rug out from under the trust and want to change the structure straight away. Just have to have a careful plan around it and just understanding the implications of if you do want to change structure. Now, this one's a really big one, the expense or asset, and it's centered around the immediate asset write-off, which is still existing this year, and I'll talk about what's changing from 1 July this year. But the key one is around this writing the asset off for tax, but understanding that it is still an asset. I just did cover off on this before, but I just wanted to highlight this again, that writing off assets through the profit and loss will distort your financial position, and it will actually it won't give a true picture of what's happening in your business. The key thing is you need to keep your assets on the balance sheet, because the tax numbers and the accounting numbers don't need to say the exact same thing. But you need to be thinking about your financials always from that commercial side of things. So assets need to stay on the books, but you still get the asset deduction. So it's sort of you get to have your cake and eat it too scenario. Work in progress. So this is a tax essential from a certain aspect, and you might be wondering, well, work in progress, how does that come into a tax webinar? The key thing that why we care about WIP so much is because we see in your businesses, and it's every single one will have the same issue of you have these lumpy month-to-month expense and income because of just how your contracts roll. So you've got multi-month contracts, and so 1 month might be where all the expenses are hitting, and then you get to a stage claim, but that claim doesn't happen until the next month. So you've got these really wild roller coasters happening if you're looking at a month-to-month profitability in the business. Now, if you're seeing that roller coaster, there's a key element that will be missing in your financials, and this is work in progress. So I'll give you a quick download of what work in progress actually is. So it's this concept of you've incurred costs up to a certain point, and you've done a whole bunch of work, but because the contract hasn't yet reached that technical stage of being able to issue the invoice, you basically haven't been able to do that till the next month. But in the month that you did all the work, you are entitled to the revenue. It's just because of contractual confinements that you're not allowed to invoice it, but you can still recognize that revenue in that same month. And the whole thing with WIP is trying to get expenses and income to actually line up in the same reporting period, which is a month. And if you can do that with WIP, and so what WIP usually does is it works out that sort of proportion that you've completed and brings to account the revenue that you should be entitled to. And you might be thinking, well, okay, you're about to add some more revenue to my books. What's the implications of that? Well, the first thing is you're actually going to start understanding your numbers a bit better. You'll see an improved financial position. The numbers will make more sense when you've actually got WIP folded into your financials, and you'll sort of smooth out this roller coaster. But then from that tax aspect, let's bring this back to what's the tax outcome for WIP is there is no tax impact of WIP. So if you're sitting there thinking, oh, if you bring this revenue to account, does that mean I have to pay tax on it? Absolutely not. WIP is a commercial accounting concept to give you better visibility, but it does not impact tax. So that's that understanding of commercial hat and tax hat and how they actually flow in your business. So we care so much about WIP that my colleague Daniel and myself ran a webinar entirely around WIP. There's a QR code if you want to grab that. Have a look at the WIP webinar because it's very, very important for a building construction business to really be folding this in to their day-to-day financials. You'll get much more clarity if you're actually starting to crack WIP. Now, this might seem like an obvious one, the tax essentials, but it's this concept of just don't be late ever with your lodgement obligations. Now, and that's across these three key areas that you can see here: super, BAS, and TPAR. So let's talk about super for a second. So super, you can't claim a deduction for super unless you've paid it. But the key thing is you have to pay it on time. So this is employee super we're talking about specifically. So at the moment, the minimum requirement for super is you have to pay it quarterly, 28 days after the end of each quarter. You have to pay it by that time, otherwise it's not deductible. And it's a permanent loss in the deductibility. So if you do not pay employee super by the due date, you're never going to get the tax deduction for that super ever. It's gone, finished. So it's really, really important to be making sure that you're putting that on time because it has such a massive tax impact and financial impact for a business if you're missing deduction for a very large part of your expenses. Let's talk about BAS now. So BAS is a interesting one from the ATO. So to give you a sort of a view of how the ATO look at lodgement and debt, the first thing they always want you to be doing is lodging, right? So don't think, oh, you know, I'm struggling to pay it, and we'll talk about that in a second. You always lodge your report on time. So if you can't pay it, lodge it anyway. So, and this has sort of far-reaching implications on things like directed penalty notices. So if you have overdue BASs as well as an overdue debt, and you haven't dealt with the debt, it's very, very highly done now by the ATO, where directed penalty notices are being issued for outstanding debt, and that basically paints a debt target on the director's back. And you have to be very, very careful of that. And a lot of that, you can sort of, there's maneuvers you can do to help work through a directed penalty notice. But if you've been lodging your BASs late, you will have a lot of difficulty actually managing that with the ATO. So always lodge on time. And with BAS these days, if you're a serial non-lodger of BAS and lodging late constantly, you may end up in a scenario where your wages for a quarter are not deductible either. So just always lodge on time, and as well with the TPAR, even though that's an administrative report, it's an important one for the industry. So make sure you're doing that on time. So once you've got everything lodged, you then have to turn your mind to the debt, right? So if you've accumulated debt, and look, building construction has struggled over the last few years for obvious reasons around your materials delays, and so debts have started to rack up a bit, tax debts, because you just haven't been able to be ahead of them. So that's something you still need to be on the front foot with. But in the first instance, the ATO want to make sure that it has been quantified and that they have got visibility on the debt, and then they'll work with you separately in relation to the debt. Now, in terms of never being late and being on time constantly, it's the most powerful thing you can be doing is actually getting connected cloud apps into your ecosystem. So what you can see here, we've got this example how we use, and this is obviously accounting centric. So we recommend this stack of you're either using Dext or HubDoc to collect invoice data, using really great AI, reading the data, feeding that into Xero, and then having a connection with something like Build Xact as well to really round out this ecosystem of data collection and being able to stay at the top of your books. And if you're using cloud-based, you can do this much more seamlessly, and it should make it much easier to stay on top of everything flowing in your business. So that's from the accounting side. But as well, Keenan being here today, that's the accounting side. You also need to be looking at things like Hazard Co as well, leveraging those sort of technologies to make life much more streamlined for you. The key thing is you really just need to be focusing on getting time back in your day. Don't spend more time than necessary just dealing with the moving parts. If you can leverage technology to do that for you, you need to be doing that. Now, this is our really quick break here, Julian. Is there any burning questions at this point?
There was one, I'm not sure Kim posted, but I'm not sure what it's in specific regards to, but she said, Josh, is that the same for self-funded retirees? So I don't know if Kim, if you can maybe just, if you're still on there, just touch on.
Potentially, it was a super question, Kim.
Yes.
So what's the question, Kim, there, sorry?
It was at 10:18, Josh. I'm not sure if Kim is still online.
That's okay.
We can jump into another one anyway. Someone did mention about, I'll just cover them off because they're here anyway and give you a bit of a break, Josh. But someone mentioned about, Hugh mentioned about the Azuko and Build Xact integrations. So I'm not sure what the official answer is there, but
no.
Yeah, I think the integration is likely at some point soon, hopefully.
Yeah.
For Hugh.
Just making sure that this is.
So Builds from John. Builds does a WIP report, and part of this asked me for a date range to be entered. My wish is if I assume to get an accurate WIP report at any given time, you enter the same dates. Josh, do you want to jump in on that? Just to have a quick read through it. Just around the date range on WIP reports.
Yeah, that's right. I'll just jump out of here so I can get back to Zoom. Zoom's jumped away on me here.
Oh, I think actually Dan's jumped in and responded actually.
Oh, good.
Yeah, so he's answered that already regarding the date range.
Lovely.
So last day of the month, Dan has said. When you upload receipts, invoices through HubDoc to Xero, can this automatically upload to Build Xact? So Lee, at the moment, no. We are going to be launching a two-way Xero integration. So assuming how it's built and things like that, what I'd imagine would happen is Xero would just take that data and then that would shoot it off to Build Xact if you want to do it that way. But I don't think HubDoc would integrate directly to us, but yeah, from Xero, the idea is going back the other way. Does WIP apply to residential builders also? That's for you, Josh, but I assume the answer is yes.
Absolutely does. It applies to every builder needs to be doing this.
Yeah, Dan's already jumped in and answered there. I think that's us up to date. Kim, if you are still on, just jump in and add a bit more information around the question. Sorry, it's just hard to know exactly when the questions come into what Josh was discussing at the time. So Dimitri, we do have an integration with QuickBooks Online. So there's that whole change in name when it was, QuickBooks, and then QuickBooks became Reckon, and then QuickBooks actually came over from the US and called themselves QuickBooks, over here. So yeah, QBO we do. So Josh, Ken's put in, they do all cost plus, WIP becomes hard with the cost plus side.
Yeah, and cost plus, if you'll be able to use cost plus in your, if it's cost plus monthly, there may be some element of WIP. Obviously, if you're cost plus and you've got the ability to run claims sort of fortnightly, WIP might not be as big of a deal because you're actually collecting the revenue faster.
As you're
So you're right, Ken. It's cost plus. If you got the luxury of being on a cost plus, you're not stuck in fixed price contracts. First thing is thumbs up, well done. And the other thing is, you're right.
Yeah, I think after the material price issues that were happening over the last couple of years, I think a lot of people are trying to move to that sort of style of contracts. But from my understanding, the banks aren't as favourable with those, are they?
Yeah, there's a few sort of new manoeuvres coming out with contracts now too, with cost plus. For those who are interested, you'll see concept of cost plus contracts with capped pricing coming out these days. So it's sort of leveraging that sort of unknown with contracts, but also helping banks actually fund, because they've got a ceiling that they can actually
go up to.
So
where would someone find information about that?
Yeah, so one organisation I know, they won't be the only one, is Master Builders.
Yeah,
have a contract that they have actually released, particularly the Queensland Master Builders arm. eDocs have it, absolutely, but have a look at it. There won't be the only provider that's looking at these sort of, just because the industry's had such a walloping, you need to start thinking about clever ways of doing contracts.
Yeah, awesome. All right, well, that pretty much brings us up to date on the questions, I think.
Yeah, we might keep going, yeah.
Yeah, awesome, mate. I'll turn my screen off again.
Lovely. Okay, so we've been through some fundamentals there, and it was good to actually see some of that chat around cloud-based technology. So it's obviously at the front of everyone's mind. So with talking about technology, and the ATO, no surprise, has some pretty good technology as well. So what are they looking at in terms of their focus? And I can tell you now, these three items are heavily looked at by the ATO because of their power with data matching these days. So the ATO are collecting a heap of information these days from various areas, various other bodies, feeding a lot of data to the ATO, which then just means that they've got more power to sort of focus on certain areas. And so one key one is the work-related expenses, and particularly work from home has been a new change to that. But work-related expenses, what the ATO really do with their data is they benchmark this type of expense labels and tax returns against similar people in the same industry. And so if there's these anomalies that happen, or you're sort of falling out of the benchmark, then it's a flag. It's a really easy flag for the ATO. And so workload expenses is something they will be focusing on as a broad concept, but work from home, that's where a key changes come in. And we'll unpack this a bit later, but the key thing with work from home now is there's two methods, and the key method that's changed is there's a fixed rate method. So you could claim certain cents per hour that you're working at home. And that fixed method still exists. And if anything, they've actually upped the rate, so you can actually get more. But because they've upped the rate, they also want you to do a bit more. So rather than just an estimated hours basis, they want you to go to an actual evidence-based approach and essentially require an hours logbook for the hours you're working at home the year. So you can actually prove when you were working, like days and times that you're actually working from home. So there is a bit more burden now on working from home using the flat rate. But work-related expenses, the key thing I want to just remind people of is, we do commonly see this, blanket claim for, 300 or 150 for laundry. Just reminding everyone that there is no such thing as a standard deduction in Australia. You still need to have a supportable reason why you're claiming something. So don't just assume there's a threshold that you can just claim just out of the gates every time. It's not the case. Now, investment properties, you might be surprised here. So the ATO conducted an audit of quite a number of returns that have investment properties in them, and 9 out of 10 of those returns audited actually required adjustment. And it was more heavily around the expenses being claimed against rental property income. So the key one that we still see coming up is this concept. You might be down in Sydney, but you might have a rental property up here in Noosa, and you might jump on a plane every now and then, travel up here to check on the property, make sure everything's all good. And you think, oh, well, that's a cost of going to, look at the rental property. Travel costs have actually been not deductible against rental property income for a number of years, but we still do see this coming through. So travel expenses in relation to residential rental properties are not claimable. The other thing that was being picked up through the audit program was particularly expenses that are large capital nature. So we're seeing circumstances where, kitchen renovations, a whole kitchen renovation was trying to be claimed as an expense against the rental income. You can't do that because it's sort of a more capital basis. So you can claim it over a number of years, but you can't claim it all up front. So you just need to be careful of the expense that you're putting in. And the ATO have got some pretty good data matching around that as well. The third one that they're looking at, and this isn't a surprise, it's sort of really been triggered heavily by crypto, is capital gains tax. So the ATO get data from all sources. They get it from exchanges. So there's crypto exchanges where you buy and sell crypto. They also get it from property as well. So the ATO just basically, they know everything about the assets that you're buying and selling. So if you're buying and selling crypto, they know about it. If you're buying and selling property, they know about it. So what their expectation is if you're transacting on those sort of investment assets, they want to see something done in the return. And if you put nothing in there, then it's just a key question for the ATO. You just don't want them coming and knocking for something that was very obviously needed to be reported. So that's what's on the ATO radar. But that's go through this section in the webinar now. That's that real practical piece, and this is the piece that gets the most interest, has the most questions come up around. Well, what can I claim? What can't I claim? Can it all be business, or is it all personal, or is it a mixture of both? The key starting point for asking this question around can I claim this as a business expense or asset is you really need to think, is this a genuine connection to the business? Am I genuinely incurring this cost for the business, or is it sort of a bit of a convenience thing that there might be a little bit of a business use to it, but fundamentally it's private? So you just need to be able to stand on 2 feet, hand on heart, and go, this is genuinely for the business. Because the key thing is it's not me or Julian that you're trying to convince that it's deductible. It's the ATO in the end that is the judge, and they just basically administer what the rules are here. So you just don't want to be in this scenario, and this sort of, as we sort of call it, a doomsday scenario, where you're in an ATO audit. You just don't want to be walking into an audit and not really have thought through something that you've claimed without having a good plan or understanding why you're claiming it in the first place. And we see business owners on a few ends of the spectrum here. So we've got those sort of owners that don't even put a personal coffee through the bank of the business, just because they don't think it's claimable. And then we've got the other side, the other end of that spectrum, where everything goes in through the business account, personal, business, everything. And what you end up with is, people like myself having to trawl through the financials and work out what isn't business related. And if there's no real good understanding or plan around why you're claiming something, it makes it very difficult. So the key thing is always when you're looking at this, can I claim it or not? Have a good plan around how you're handling it for business and personal, because in a lot of cases there's a split between both. Just need to understand it, have a good plan, and the key thing is be consistent and stick to it. Don't keep changing it around. Now let's get into the real specific ones. So work from home, this is a sort of a topic that comes up a bit because a few different sets of rules apply around work from home, and it depends on the specific nature of work from home you're doing. So there's a few different ways that work from home are looked at. So there's working from home on the couch perhaps, versus having a fully dedicated sort of office or business space in the home or even connected to the home that's very obviously just for business. And the key thing that's calculated around this is a simple math around square meter rates. So a very simple proportioning rule applies around this a lot of the time, where you look at that area that you're using for business as a proportion of the total house, and what's the percentage and what can I claim. So we've got a neat table here that actually walks through these different scenarios that you have. So the first one being the work at home, you don't have a specific office space. And so it's difficult to really segment this one part of the house, because you might have maybe a desk and a computer in the living room, for instance. And so you can still claim something for this. And this is on the basis you're not using that fixed rate method too, by the way. So this is you wanting to claim the actual running costs using a methodology. So you can see here in the table, so if you're just working at home in no particular obvious space, you can still claim things like your computer, desk, mobile phone use, and some of the utilities on a proportionate basis, but you won't be able to claim things like the actual other assets around, like curtains, carpet, rent, insurance, interest, all that sort of stuff, not going to be claimable. And then you should go to the next step, which is a home office at home. So you've got a separate room in the house that's been converted to an office or already existing office space. It's very obviously a specific room and space for work, and you do actually spend a decent amount of time in there at home doing work. So that's when you start opening up further deductible ability working from home. So you can then start looking at the assets in that room, carpets, curtains, those sort of things. You might be able to start claiming depreciation on those things as well. But again, at that point, even though you might have a home office, you're still not in a scenario where rent, mortgage payment, interest, insurance are claimable. It's still not yet at that point. Then we go to the full place of business at home. And this might be where you may have even extended the home or have a very obviously separate part of the house. You may even have a granny flat office on the home. That's where you've actually changed the nature quite heavily in terms of what you're doing. So place of business is also then meaning that you've got clients coming to the premises, in the home, this office space. You might have employees working out of that space, and so it's really then a place of business that is at home rather than a home office, because you're actually conducting the face of your business from this space. That's when you're looking at a full ability to claim proportionally, again, across all those areas of, what are you consuming, telephone use, depreciation, and even starts opening up being able to claim interest, insurance rates, those sort of things as well, when you've got that obvious place of business at home. So again, it's looking at this proportion approach, is square meter rate, square meter as a proportion of the overall space, working out proportion. You also need to look at, making sure you're definitely using it all for business, or if there's some personal, you may need to do a sort of further apportionment. But that's the sort of key: work from home to place of business, framework that you sort of need to operate in. Now let's move outside the home now, and might be a shed that you've got down the back. So this one comes up a little bit, the shed, and again, you need to be coming back to, is there a genuine basis for wanting to claim part of this in the tax return? Is there an actual genuine business nature to this? And again, we're looking at square meters, and it's sort of you really need to have a sensible approach to this. So you look at the shed, right? You might put the tool trailers in there, the cars in there, work vehicles in there. You might have tools stored in there, but over in another corner, very obviously, you might have a jet ski, might have your ride-on lawnmower sitting over there, a boat maybe to the side. So clearly, you've got a mixed use to this space. So again, looking at how much of that space of the shed is used really for business related versus what's personal. Sorry, thanks, Kenneth. What's the personal side? And looking at that proportion, and once you determine that genuine proportion of business and personal, then using that sort of calculated percentage to then start claiming some of the holding costs of the shed as well on the property. So again, it's coming back to just a sensible, genuine, and definitely reasoned basis for where you're claiming it. Now, the really interesting one, this is the one that gets the most interest, is vehicles, and there's a lot of confusion around vehicles as well. And so, probably the best way to start with talking about cars and commercial vehicles is actually, what are the differences here? What's the technical difference between a car or a commercial vehicle? And there's this key, everyone's probably heard it, this key 1 ton carrying capacity of a vehicle. So if you've actually got a ute that's got an actual carrying capacity of 1 ton or more, there's very high likelihood that it'll be a commercial vehicle. So i.e., it's not designed to carry people, it's really designed to carry tools or actually do business, particularly builders carry stuff. Its primary use is to actually conduct the business and not carry people. Now, cars, on the other hand, you may be looking at like 4-drive wagons, those sort of things as well, like Land Cruisers. Well, because there is no real carrying capacity to them, their whole role is really to carry people. It's difficult to call them a commercial vehicle, and they don't have the carrying capacity anyway. So they then fall under the banner of being an actual vehicle. And if we're talking Land Cruisers, the key thing to be aware of is the luxury car depreciation threshold, and that's 64,741. So basically, if you don't meet the condition of being a commercial vehicle, then you have to look at what it's now a car, and if it is a car and happens to be over that 64,741 threshold, it then goes into the realm of being a luxury car. So basically, what the ATO's guideline on that is anything over the 64. So say you spent 80,000 on a Land Cruiser, and say you're able to still prove that it's 100% business, only 64,000 of it is going to be tax claimable. Whereas on the other side with commercial vehicles, if you've met that 1 ton carrying capacity and it's clearly a ute not designed to carry people, then you could spend 80K on it, and the deduction for that, assuming 100% business, would be 80K. So that's the first distinction you need to be aware of cars and commercial vehicles. Now, if you have got commercial vehicle, you met this 1 ton basis, and you go, okay, yeah, it's commercial vehicle, it's all business. It's not as simple as now you can just go and use the car 100% personally, but still get the tax write-off. So you still need to be acutely aware of commercial vehicles to still be eligible to be 100% deductible. They need to have minor and infrequent use that's personal. So you can't get the deduction, you might get an 80K deduction for a vehicle as a commercial vehicle, but you can't be going over the beach every single weekend with your sign writing on it and only sort of using it a little bit for business. And so what that then comes back to is a core expectation of being able to prove what's business and what's personal with motor vehicles. And the key tool that the ATO refer to are logbooks. And so a logbook is, that register that you keep that tracks every every trip you do, business, personal, and the minimum requirement is you have to keep that for 12 weeks, a logbook. And so cars, they're not commercial vehicles. If you want to claim a car, 100% of the time, you need to be doing a logbook to actually justify your business with personal. With commercial vehicles, it's a bit tricky because you need to be able to prove that there is only minor and infrequent use of the vehicle. And it might be difficult to prove that. And you may very strongly consider still doing a logbook anyway to prove that, yeah, that vehicle is being used primarily for business. Now, the 1 ton capacity is an interesting one. You see that we've got the Ram on the screen there. It looks like a big, tough carrying capacity vehicle. Interestingly, a lot of Ram models don't actually meet the 1 ton carrying capacity. And so that doesn't necessarily mean that, oh, well, it's not a commercial vehicle at all. There's still a calculation that you need to do. And the core to it is it's still, the vehicle just can't be primarily for carrying people. So Rams are still possible, but don't assume that a Ram big vehicle like that has 1 ton and it's automatically commercial. So just understand those moving parts with vehicles. And if you don't fully understand, the best thing you can be doing is asking a accountant like myself, if you want to buy a certain vehicle, what is it? And does it meet the requirements? And then fold in that logbook requirement. Now, we've got some other toys that sort of come up as we see as well. Planes, boats, caravans, very, very common to come up, surprisingly. Boats and caravans more than planes. Planes, you're probably going to struggle. You'd be probably squinting to see how that's connected to a building construction business. I'm not saying it's impossible, but you would have to have a very strong reason argument as to why that would be claimable. Boats are probably the more interesting one that we see come up. And again, it comes down to the genuine nature of why you're having it, why you're calling it business. So if you, most of the time, do all of your work on land and you just happen to have a few things on islands that require a watercraft to get there, it's probably going to be hard to justify that you can claim this whole boat as a deduction because you're only sort of doing a little bit over there, but otherwise every weekend you're out fishing in the bay. So you just need to really understand the genuine nature. So on the flip side, if you're a builder that has a really niche market of doing work offshore, then you're probably going to have a better justification. But again, it comes down to you need to be able to prove it. How do you prove that? You need to keep good records, logbook type records, again, proving why and have a really good reason why. Caravans are probably the less complex one to deal with in terms of this. Again, if you're looking at generally just one geolocation that you do most of your work in and you just happen to do a few here and there, but otherwise use the caravan for Easter weekend or Christmas and it's used heavily privately, you just need to be aware again of how much of this asset is actually being used for business. And we've seen it, it's very possible. There are some businesses that do remote work, and you may even do potentially some insurance work as well in different states to help out. Then caravans may actually be a very good solution to actually have a mobile team. You just need to be able to justify it. Now, the key tax planning tips that I actually want you guys to take away as well from this across these sort of 3 areas. And now super contributions is one that we sort of have to be careful about how we talk about it. So I'm not a financial advisor, so I'm not allowed to actually tell you whether you can, whether you should or should not make a super contribution. But what I can tell you is, this industry, the facts of this industry are that many of the business owners on this webinar and people working in the building construction industry really fall behind when it comes to super. And it's because a lot of other industries have a really forced super through mandatory contributions, but a lot of these business owners running building construction, or even if you start out as a contractor, a sole trader, super is the last thing you're thinking about because running a business, the first thing you're thinking about is paying your employees super, and you guys don't really think about your super until the very last minute, or may not even think about it at all. And so it's a really unique opportunity for business owners to really understand super contributions. And whilst I can't tell you, yeah, you should definitely be making super contributions, you do need to be having a conversation with a financial advisor and really understanding that, you know, should you be doing this? Now, what I can tell you is what are the actual caps for super contributions? So the tax deductible cap or the concessional cap is 27,500 this financial year. So basically deductible contribution up to that cap, 27.5. But just be really mindful, if you are on wages in your business, the 27.5 cap actually includes employer contributions. So if you've got, you know, 10,000 worth of contributions made already during the year via your salary, then you've only got 17K left in that cap to actually make a contribution. So just be aware that it includes both your personal contributions you're going to claim a deduction for and your employer contributions. But the key thing I want you guys to take away is really have a good hard think about it, because a lot of times you guys have probably forgotten about it, and that's something you really need to be focusing on for your own strategy. Now, bad debts are one of them might come up as well. So in the last few years, obviously things have been tough, and working with customers has not always been easy, or it's not easy. And you may have issued an invoice in a prior year for, you know, you've finished the work, issued the invoice, and you've reported it as income in that prior year. But for a variety of reasons, you haven't been able to get paid for that work. So you've tried very hard to collect the money, and after, you know, trying as hard as you can to collect it, it's not going to be paid. And so you go, I'm going to have to write this invoice off. And so after clearly identifying that you're not going to get the money, you write the invoice off in a subsequent year, you actually get to claim the deduction for doing that. And the key reason is you've had to pay potentially tax on it in the prior year. You shouldn't get penalised for it in future years if you never got the money. So have a look at any invoices that are long overdue, and if any invoices you're clearly not going to be paid, have a think about, should I be claiming a bad debt deduction this year? Now, the instant asset write-off, we've covered off on it a couple of times here in the webinar, but this point around the instant asset write-off is more of a cash flow thing. So I really, really strongly want everyone to think about the instant asset write-off from a cash flow perspective. So if you don't need the asset, don't buy it. So there's no point spending a bunch of money just for a tax outcome, because that's not going to actually achieve what you expect. So in the first instance, do I need the asset? If I need the asset, yes, I probably can buy it this year. And so the thing with the instant asset write-off is changing from 1 July. So you would have seen potentially in the budget that from 1 July this year, the immediate write-off for assets is dropping down to 20,000. At the moment, this current financial year, it's unlimited. So you need to have a think about that quickly before the end of the year. Are there any sort of major assets costing more than 20,000 that you need for your business? You probably need to think about, you know, buying it this year and claiming the deduction this year whilst that cap is still available. Now that's the practical side. Now we spoke about this earlier in the webinar as well, around, you know, don't be late ever, and, you know, what if you do have actual debt and dealing with debt with the ATO. So off the back of COVID, as we know, there's been lots of ups and downs and a lot of businesses struggling through COVID, and more often than not, the debt that has accumulated is tax debt. So debt due to the ATO, for it could be GST, PAYG, income tax, has been creeping up. And to sort of help alleviate these businesses that have been struggling, you know, some legislation was put in place called the Small Business Restructure Process, where it opens the door to small businesses to be able to actually do a deal with creditors to perhaps, you know, get a bit of a lifeline thrown and, you know, reduce the debt. And so heavily being ATO debt, you can go with a proposal, as long as your business still has good, strong viability. You can take a proposal to the ATO and go, look, I can't pay you 100% of this tax. My business is good now. We're coming out the back of COVID, but I'm not going to be able to afford to pay all of that tax. You know, put a proposal to, can I pay cents in the dollar? And the most common one we're seeing through the small business restructure process is taking a proposal to creditors, going, I can pay you 20 cents in the dollar. And a lot of these have been accepted by the ATO. And the small business restructure process isn't that heavily used in Australia at this point. So there's only about 100 of the SBRP process that have actually been done in Australia. So it's not widely known, but it's very, very useful tool to help get a bit of a haircut and get some years back from being able to crunch some of the debt. The key requirement is the overall debt that you owe to all creditors, not just the ATO, must be less than $1 million. If you met that, and as I mentioned before, don't be late ever, make sure everything's lodged and up to date. You need to make sure your super is also paid as well to be able to access this. So if you've sort of accumulated a bit of debt, we've got a whole division in Xact dedicated through our CFO advisory to working with businesses and also helping businesses through the SBRP process as well if you've ended up accumulating debt and want something to help jump over it. Now, federal budget, I've just covered off on the instant asset write-off, so that's coming down to 20,000 from 1st of July. There's another thing in there about green energy incentives for businesses, and that's just promoting some more spending in that green energy space and giving some incentive to business if you do spend money around green energy. Build to rent, this is probably not going to impact a lot of operators, particularly those on the call directly in terms of an opportunity. If anything, the build to rent's a really big program that might actually start directing some labour away from other sort of building construction business to sort of focus on those bigger programs. So I know it's probably going to put a bit more stress on an already stressed industry around labour, but just be aware of that. Those bigger programs may have an impact. Now, payday super. This one's a really critical one that's coming in the not too distant future. So in a couple of years' time, the ATO will require that at every payday, so it could be weekly, fortnightly, whatever pay cycle that you're paying your employees, they're going to expect that you also pay the super on that same pay period. So that's what they call the payday super. So rather than this quarterly program, it's going to be mandated that you pay it every payday. So if that sort of requirement's coming in, you really, coming back to this technology thing, you really need to be using cloud-based softwares that already have the functionality for this, just to streamline this. Because if you're going to need to comply with this, you need to be using software that can do it seamlessly, so it's not a lot of heartache trying to comply with payday super. The other one is the lodgement amnesty, and this is giving you this opportunity now. So again, coming back to the never lodging late, if you have ended up, so this is between December 21 and February 22. So if you have ended up getting behind on BAS lodgements or income tax lodgements, typically before this was in place or coming in place, if you lodge things late, ATO issue late lodgement penalties to businesses. And so there's this window between December 21 and February 22 where they're going to go, well, if you bring these up to date for lodgements that were originally due in that period, we're not going to charge you late lodgement penalties. And we're going to give you this opportunity to just get your books in order, get your house in order, get up to date again, and we're not going to issue penalties for you. So that's a really important one for businesses that are still trying to get back on their feet off the back of COVID. So be aware of that as well. With anything with the federal budget, obviously there are announcements. They still need to become law, so they're not yet law, but I would expect that these ones will be coming through and will be signed off. Now, we've spoken a little bit around cloud tech today and some interest in this. And you can actually take your cloud stack one step further. So we're talking about having financial visibility with WIP, so understanding numbers, folding that into getting visibility on the business, but you can actually use technology to do this as well. So we've spent a bunch of time, we've worked very closely with the Build Xact team, and we've actually built a dashboard product called Xact Analytics. And it's a product that sucks up Build Xact data, sucks up Xero data, and it reports in a really easy to use, you can even look at it on your phone, dashboard of how you're performing in the business. And it gives you a drill down all the way down to job by job. So you can see the job profitability. So you planned to make this in the job. How are you going during the job? So not waiting to the end, during the job, how are you going? Are you on track? Are you under, over? And just giving a really quick information in a dashboard form. And the really exciting bit about this is working with Build Xact over the last sort of 12 to 18 months on this. Build Xact are actually going to be integrating this Xact Analytics dashboard into the Build Xact software. So for Build Xact users, you'll shortly be seeing a new feature come out, which will be an Xact Analytics sort of dashboard, which will be embedded in the product. And you'll see the power of getting visibility on your data with that. Really keen to hear feedback from the industry once that comes out, and those who are using Build Xact. And you can see there's a QR code as well. If you want some more information around our dashboard and how it can help you, please reach out. We think it's a really cool product to give you guys some visibility back in your building construction businesses. Now, what's next? We've come to the end of the webinar. I want to make sure that I don't just sail into the sunset, dust my hands and disappear. I want to make sure I've opened the door for anyone to reach out. So there's a QR code, grab it. You get the opportunity to have a free 30-minute consult with myself or my colleague Suz to talk about any of the aspects of this webinar. Book in a meeting. We're more than happy to share our thoughts, or if you just want some second opinion on something, reach out. We really want to help you guys. And that's me, Julian. Let's see if we've got some more questions coming through.
Thanks, mate. That was great. I remember when you went through the plane thing, I remember sort of giggling at that last year and thinking,
yeah,
trying to, people trying to push the boat out, push the plane out.
Roll the plane out of the hangar and let's go to work.
What would be an example of someone trying to claim a plane?
Basically, justifying that I have to work in
regional areas.
Yep. Yeah. And the only way to get there might be using aircraft, or in the moment, it's planes are probably a harder one to use. The helicopters are probably one that probably be pushed a bit harder because you can sort of more portably drop them around, can't you?
Yeah, exactly. Josh, can you bring up that QR code again?
I certainly can.
Just Lee's just asked for the consultation there.
Absolutely. Just on here for a second. Share screen. Okay, I'll just leave it there. We can have a chat through some questions.
Yeah, awesome. So Renee, you've popped in about help getting MYOB, migrating MYOB with Build Xact. If you want to shoot me an email, I'll just drop my details in. You can just shoot me an email of what you're trying to do, and I'll see if it's something that Build Xact can help with, and just maybe try and find you the right person. And then if that isn't us, then it might be somewhere. Josh, do you guys work with MYOB at all, or is it only Xero that you?
Oh, we have some. We do some work with MYOB, but large majority is Xero. To be honest.
Yeah.
But it depends on what it is. We do know a lot of people in the industry that would use it. So if it's something we can at least direct someone in the right direction, more than happy to. Yeah.
Yeah, awesome. Well, Renee, either myself or I guess Josh, you can probably help direct as well. But feel free to email Renee. I'll have a little look anyway. It might be something we can do from a support side, and we'll just get you booked in on the time if it is something. I just want to double check because I think Dan and Suz have been jumping in and answering the questions anyway.
There've been little ninjas in the background there.
Yeah, it's been really good actually to have that. It's hard for us to keep track of the specific questions as it's coming up. Okay, so Dan's answered. So Phil from Xact Accounting. There's a few of these guys on the chat today.
More Xact Accounting people. What's this?
Yeah. There's a link there to get in touch with Xact Accounting. So
perfect.
I want to reach out outside of the the QR code 30-minute consultation.
Yeah.
So that's Renee's. I think Ken's questions are answered. Suz is jumping in. I think
Daniel just mentioned, I think most questions are answered.
What was that? Sorry, they are answered, are they?
Yeah,
Yeah, awesome. Well, if they're all answered, then we probably don't need to go in.
Well, that's worked out well this year, hasn't it? Julian, the ninjas have
Yeah,
worked well.
exactly.
Thank you,
There's
Dan.
something-
Thanks, Suz.
There's Mitchell put one here in the Q&A. So, an example of business that can get a plan as a deduction is a mate of mine that is a livestock agent. Oh, plane, sorry, a plane is a livestock agent. Has to fly remotely interstate to auctions. Yeah, no, that makes sense. Yeah.
Yeah, something that's required insane. Yeah, there you go, Mitch. That's great. Yeah, there's a good example.
Yeah, I'd
Building
imagine
construction business though, I might be squinting to get a builder to you. But I'm not saying it's impossible, but you might have to squint.
Yeah, getting materials in would be tough for sure.
Absolutely.
So Phil's just added in the WIP accounting masterclass video, so definitely go in and check that out, guys.
Definitely check that out. Have a look, and if you have any questions off the back of it, because if you're new to WIP, absolutely reach out. Just don't hesitate. Reach out to us.
Yeah, absolutely. And just a quick reminder as well, guys, join that Facebook page, the Build Xact building blog. Even if you're not a subscriber for Build Xact, it's a really good tool for information. Hopefully it'll get you at some point to jump on and give us a try, but definitely just hop in there just for advice and things. It's where we sort of talk about a lot of the new features that are coming. The next month or so is going to be a fairly busy one for Build Xact. So the mobile app is coming very, very shortly. And then obviously there'll be iterations of that, and it'll get, more fully featured, as the releases follow. Guys, to be honest, I think we're mostly done. I think so. The guys have been jumping in and answering the questions. That's been great. Keenan, have you got anything that you wanted to touch on?
All good, man. As I said, if you need any help, feel free to contact me or contact anyone from Hazard Co or even Build Xact, and we'll be happy to show you something.
Yeah, Keenan, do you mind, if you haven't done so already, do you mind just popping your email in a chat just so people can grab
Yes,
that? And we can direct people over. People are dropping off now anyway, so I think that's normally our call to wrap up anyway.
Wrap
Yeah, just obviously a bunch of people just saying thank you. I mean, I didn't really do much here. I mean, it's mainly Josh on this one, so but I'll take the thanks. I'll take the thanks.
You can take it.
for bringing Josh on.
You did put the nice music in the beginning, so that's good.
Thank you for the music. Yeah, thanks for the music.
I did exactly. All right, guys, we'll call it there. Obviously, thanks in the background to Suz, Phil, and Dan for answering the questions. That's been great. Yeah, awesome. So Brett's just sent through a connection, a consult inquiry. So that's awesome. Need some ACDC next time. All right, I'll look into ACDC next time, Phil, for the. We tried to make it a little bit chill,
Chill,
go and get a cup of tea before you join on. I don't know if ACDC might be a bit gung ho for tax.
Yeah, Highway to Hell and tax doesn't work.
Yeah, Highway to Hell and tax. I can't say that's a good connection, Ken. Yeah.
Highway out of hell would be better, I think.
That's better. Yeah.
Yeah.
Back in black. Thanks.
Yeah. That's actually very well done. All right, guys, we'll call it there. Thanks again, Josh.
Thanks, Julian. Thanks, Ken. Great. Thanks, everyone.
Awesome. See ya.
Thanks, everyone. Bye-bye.